Welcome to Taxtron Web Tutorial Video Series. In this video, we will learn about rental income, how to report it on your tax return, and the types of expenses you can claim on your rental statement. Let's get started. Rental income is the income you earn from renting out a property that you own. This income is categorized as passive income and should be reported on Form T776, Statement of Real Estate Rentals. Now, you might be wondering who should report this income. The individual who owns the rental property is responsible for reporting the net income or loss on their tax return. If multiple individuals owns the property, each co-owner must report their respective portion of the income or loss on their individual tax returns. There are two types of expenses you can incur: current expenses and capital expenses. Current expenses are related to the day-to-day activities of a business or investment property and are deductible in the year they are incurred. Here are some examples of current expenses that you can report on T776. Repair and maintenance. Advertising. Insurance. Interest on money borrowed to purchase rental property, except for vacant land. Property taxes, except for vacant land. Utilities. Traveling expenses. Modifications made to the building to accommodate disabled persons. Cost of supplies and janitorial work, not including the value of your own labor. Salaries and wages paid to security guards, superintendents, and other employees. Accounting and legal fees, with some exceptions. Automobile expenses. On the other hand, capital expenses are incurred to improve or extend the life of assets or property beyond their original condition. These expenses are deductible over the lifespan of the asset or property and typically provide a benefit that lasts for several years. Examples include buildings, land, machinery, computer hardware, vehicles, furniture, and fixtures. There are a few important points to keep in mind when reporting your rental statement. No contribution to CPP is required. Rental income is not considered active income for childcare expenses deduction. If the rental property is bought under a minor's name, the income will be attributed back to the parents. You cannot use capital cost allowance, CCA, to create or increase a rental loss. Now, let's see how we can report a shared rental statement between a taxpayer and their spouse using Taxtron Web. First, log into your Taxtron Web account and prepare a linked tax return. To access T776, go to the Income tab and answer yes to the question, "Did you receive self-employment or rental income?" Click Next, and you will see the same income screen for your spouse. If you have only one rental statement shared with your spouse, report it on the taxpayer's side. The percentage your spouse holds will be automatically reported on their tax return, which you can verify by printing the record keeping of your spouse's tax return. Next, click on the self-employment profile and check the box for rental income. Click Next, and you will land on the Identification tab where you need to specify the year period of your rental statement. Verify and enter the rental property address and answer whether this is a partnership. Answer yes to the question, "Is this statement shared with your spouse?" Enter your spouse's percentage as 50%. If you scroll down, your spouse's information will appear in a specific column. Enter the taxpayer's percentage manually, as there might be sharing with a third person. In our example, the sharing is between husband and wife, so enter 50% in the husband's information column. Next, enter your gross rent. Let's assume the gross rent is $34,800. Now it's time to enter the expenses. As we learned before, there are current expenses and capital expenses. For this example, we will report the following current expenses: $3,310 for insurance. $17,730.32 for interest expenses. $250 for legal accounting and professional fees. $4,512.44 for maintenance and repairs. $5,400.61 for property taxes. $264.80 for other expenses. This totals $31,468.17 in expenses. Next, answer yes to the question, do you have assets on which capital cost allowance, depreciation, can be claimed? Select the correct class. For this video, we will claim CCA for a building acquired after 1987, so select Class 1. Since the taxpayer claimed CCA for this building in previous years, enter last year's undepreciated capital cost, UCC, at year-end as $19,200. In the UCC at Start column, the software will calculate the maximum allowable CCA for you. If you want to learn more about capital cost allowance and net rental losses, we have covered this in another video, and the link in the description below. If you have any additional information to report, add it now. Otherwise, click Next to land on the rental summary page. As per the 50% partnership, both the taxpayer and spouse have a net rental income of $1,665.92 each. If you want to see the T776 form, you can click on the Summary button to open the taxpayer's T776 in PDF format. To view your spouse's T776, go to Review and File, print your spouse's record keeping, and scroll down to find T776. Thank you for watching. We hope you found this video helpful. If you have any questions or need further clarification, please leave a comment below. Don't forget to like, subscribe, and click the bell icon for more informative videos.